Hello. So today's question or topic that I want to cover is how do I read a profit and loss statement for a business? Now, this profit and loss statement is going to be for any type of business that would be a sole proprietorship or that would flow onto an individual tax return like a 1040. Not going to be a corporate profit and loss or a C corporation profit and loss. This was just going to be a Schedule C, which flows directly to your personal tax return. So that being said, all of the numbers on here would come on a business that would be a doing business as, or in the example I'm doing is Joe Smith, which is Joe Smith Contracting. So Joe Smith Contracting business return would flow to the personal tax return of Joe Smith. So that being said, I have two different examples. Both are typically what you would see on the cash flow statement. The contrast between the two is one is set up as showing a profit but not being ideal to a banker or a financial institution to lend money. The other one shows a loss, but it actually looks better to be able to borrow money. And that's what I'm going to show you today is the two comparisons. So when you look at how I can borrow money for my business, this is how your financials want to tend to look. I'm not saying to do anything unethical or cheat the government or cheat the system. There are legitimate ways that you can show less income, but also show good cash flow for your bank or your financial institution. So that's what I'm going to show you right now in the two examples that I have.
Okay, so like I said, this is the profit and loss from Schedule C of a 1040 tax return. Now, a lot of the boxes on here are kind of self-explanatory. You have your name of the proprietor, which is who started the business, what the principal name of the business is, or should say, is down here, the principal name. And then this is the business profession or what they do. So if you were in auto sales, that's what it would be. Your business address is on here. Now, your business address could be different from your home address, obviously, if you rent a facility or lease a facility or own a different facility that's yours. Your accounting method here is going to be cash, accrual, or other. So cash, you realize expenses and income as they happen. Accrual, you realize income before you get it and expenses before you have them. I can go into a more in-depth video on that later on. So here's where the meat comes in of the tax return. You have your gross receipt from sales. So in this case, it's a contracting business. So all you would have is sales. You wouldn't have cost of goods sold, which would be your retail business. So if you had 145,000 in sales, but it costs you 100,000 to make that, such as inventory, that's where your cost of goods sold would be. So in this case, it's a pretty simple example. You just have sales, 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 and gross profit. Now, down here, your expenses. This is where you can alter some of your expenses to show less of an income, so that way you minimize your taxable liability. In this case, we had Joe Smith, who had $2,500 in advertising, $18,000 in car and truck expense, contracted labor of $58,000. So this means he used subcontractors. So he used plumbers, electricians, people to do drywall, landscaping, things like that. That's who he paid that to. Depreciation is a non-cash expense. So if he had 10 vehicles, let's say, that he purchased in this year, he would depreciate them $4,500 a piece. Is a good way of an example. Mortgages, this is insurance that he pays on money. So other could be something as credit card insurance, or if he has a private loan through a family member and he pays interest in, that's where it would be. $500 in legal and professional, say he got an accountant or an attorney. Office expense. This could be such things as paper, um, cups, coffee, anything like that that he provides as an office expense. Some of the other ones, if he rented or leased, that would be here. Any vehicles, machinery, or equipment that he purchased this fiscal year that he wants to use as a write-off. I think the standard is $2,500. Anything over $2,500 you can actually depreciate, which would go over to this column here. So wages. These would be full-time employees that he hires. Now, this isn't money he pays himself. What he pays himself is down here. This is what's left over from the business. Now, as I said, when you look at this business lost money on paper. But as you look at it from a financial institution perspective, so here we have his gross income, which is the 145 that we have here. He have all of his expenses that he put down, which are all here, which equals $151,300, which is what was here. Now, Joe has some personal debt that obviously you can't see on the Schedule C. So he's got a house payment, a truck payment, credit card. Now, living expenses is something that every financial institution is going to put down. These are the living costs that it costs Joe to live. Things that aren't covered, child care, taxes, those types of expenses. So his total debt yearly is this amount. Now, the way that financial institutions look at financial tax returns and sheets is we take the net profit, which was a loss, we add back in your non-cash expenses, which are depreciation, and we add back in your interest expense. The reason we add this back in is because this interest expense is a pre-taxed expense, which means you pay, or after-tax expense, excuse me, you pay taxes on that $1,500. So we credit it back, which means that this business actually had a net profit of $40,200. Now, the way the banks and financial institutions calculate whether you can make a repayment is it's called debt service coverage. It's how many times your income can cover your debts. Now, because Joe is self-employed and he has no other income, this is what we have to take as his income to the household. So his total debt payments are all of his expenses over here, which is the $26,700 divided by his income. His income divided by all of his debt means how many times he can cover his debt payments with his income is 1.51 times, or 151%. Industry standards, banking is typically anything greater than 1.15 or 115% is considered acceptable to lend to. So this is how that number is achieved. So if you ever go to your bank or your financial institution, they say your cash flow doesn't cover your debts, this is what they're talking about. So it's a really simple calculation. Debt service coverage equals total cash available for debt repayment divided by total debt payments. So you can see as this number, as income goes down, this is going to go down. All right, so that's our first example. This is a business that shows a loss on their tax returns, but is able to cover their debts. Now, the second example I'm going to show you, as you can see, his sales are lower. Now, he has less depreciation, a little more contract labor, other expenses pretty much stayed the same. Now, on paper, his business shows that it covers it made $700 in profit. So over here we see we have all of his expenses equal there, so you can see the 700 in profit. Now, we take the profit plus the depreciation plus the interest, which is from here and here. Now his net profit is $20,200. Again, if we apply the same calculation utilizing his debt and his profit, he only covers his debt at 76%, which means he cannot cover his debt with the cash that he makes. Now this is counterintuitive of, oh, I made a profit here. But in the long run, this is a business that it would have a hard time getting financed. So that's kind of how to explain the profit and loss statement. And I hope that made sense, and I hope to do my next video, I will go over the balance sheet. Now for my next video, I'm going to be going over the balance sheet, and that way I can show you an example of what a balance sheet looks like and what we look at it in the financial industry for strengths and weaknesses.
Okay, so I hope that gave you a little more understanding of how the profit and loss is laid out on the tax return and kind of the different areas in which you can alter your profit to minimize your taxable liability, but also maximize your cash flow for when you want to go borrow money from a bank or financial institution. I hope that the explanation made sense and that you took a piece of valuable information away, because that's the whole reason I'm here. If this did give you any kind of information you can utilize, I would appreciate a comment or a like or something to that effect. Or if you brought up more questions that you could think of that you would like answered, drop those below. Thank you again for watching. I really appreciate it, and I hope you have a great day. Thank you and goodbye.